Let's start part B of question number 3 of the pilot paper for June 2026 examination, right? So this particular pilot paper was issued by CS Sri Lanka in January 2026, targeting for June 2026 examination, right? So as usual, let's look at the requirement of the question. What is the requirement? Part B, advise the management of gamma on determining the fair value of land based on the applicable accounting standards. And now first part is actually what? Determining the fair value of the land based on the applicable accounting standards and accounting for the fair value gain in the financial statements, and how to account for the fair value gain in the financial statements for the year ended 31st March 2025. How to determine in the land and how to account for the determining the fair value of the land and how to account for the fair value gain in the financial statements for the year ended 31st March 2025. Then part C is also relevant to this particular scenario, that is based on the information provided, prepare 4 disclosures that are to be required. 4 disclosures that are required to be presented in the financial statement for the year ended 31st March 2025 based on SL-25-1 fair value measurement standard. As per the fair value measurement standard SL-25-1, right? So you need to prepare how many disclosures? 4 disclosures. 4 disclosures that are to be presented in the financial statement for the year ended 31st March 2025, because this standard requires certain disclosures to be made in the financial statements in terms of the fair value measurement of the assets. So you need to prepare 4 types of disclosures which are relevant with this particular scenario, right? Now we understood the requirement. Now let's read the question. Let's read the question. Gamma's books, so our company Gamma books carry a land parcel of 320 purchase, the purpose of which has not been determined by the management. So they have a land. What is the extent of the land? 320 purchases. As the land is carried at market value, in the financial statements, valuation was carried out by a professional valuer as at 31st March 2025 to be incorporated in the financial statements for the year ended 31st March 2025. So there's a professional valuer who has valued the particular land, right? And that valuation has to be incorporated in the financial statements for the year ended 31st March 2025. The valuation report contains following information. You have the following information. Value of the land, purpose, value per perch, and significant assumption made. If constructed as an apartment and rented out, because not now here, one of the important criteria that's mentioned over the first para is purpose for which has not yet been determined. Even though you have this land, you have not decided the purpose of having this land, right? That's why you have been given the valuations under a couple of options. It can be used for anything. Now, one option is to construct an apartment on this land and rent that out. So the value per purchase in that case 1.5 million, right? So for the computation, now seems that they have done a value in use computation by projecting the future cash flows. So for that, company has, or the valuer, actually the valuer has taken the discounting rate of 8% and the growth rate of 10%. Then if developed as a resort, another option is to develop that as a resort, not as an apartment, but as a resort. If that case, the value per perch would be 1.6 million. And for the cash flow projection, value has taken discount rate 8% and the growth rate 12%. Right? Then moving on, As a sale transaction occurred in the previous year involving nearby land, the valuation in the prior year was based on that transaction price. Okay, so that means these information are relevant for what? Current year valuation. That is for the year ended 31st March 2025. So you have to incorporate the fair value as at 31st March 2025 in the year end statement of financial position. So for that you have taken the service of a valuer and the valuer has given these details, right? So here the value per purchase was given. On the other hand, in this para, you have the number of purchases. So you can get the value of the land by multiplying value per purchase into the number of purchases, that is 320. But you have two options here: value as an apartment and value as a resort. Now, the next para explains about what they have done in the last year. As a sale transaction occurred in the previous year involving nearby land, the valuation in the prior year was based on that transaction price. So the last year they have used a different approach to value. What is that? So what is the approach that they have used? As a sale transaction occurred in the previous year involving nearby land, the valuation in the prior year was based on that particular transaction, which is 1.3 million per purchase. No comparable transaction occurred close to the current financial year. Now, what has happened is last year what they have done is they have not taken the support of a valuer. There was a recent transaction at the year end. That means last year means 31st March 2024. At that time, one of the plot or one of the land nearby was sold close to the year end. So you have taken the price of that particular transaction to value your land. That is allowed. Okay. So accordingly, what was the price per purchase? 1.3 million. Yet again, you have 320 purchases. So you would have valued by using that method, 1.3 million into 320. Right? What would have been the value? 1.3 million into 320 purchases. So 416 million. It would have been 416 million. How did I get that? 1.3 in millions into 320 purchases. Right? Then current year, 31st March 2025, we have not yet determined the fair value. That we need to do in the question. But why we couldn't use the same basis in the current year, 31st March 2025, no comparable transaction occurred close to the current financial year end. Current year, close to the year end, 31st March 2025, no transactions of this nature has occurred, so that you had to move to a different basis of valuation where you had to take the support of a valuer, and that valuer has given two options. If it is an apartment, what is the value per purchase? If it is developed as a resort, what is the value per purchase? Then 𝐓𝐫𝐚𝐽 does not have experience in operating resorts. Right. So the company doesn't have any experience in operating a resort. Seems that they have some experience in operating apartments. Right. It's not mentioned clearly in the. So is it mentioned their business under their business activities at the very beginning? What business that they are in? Yeah. So they have the knowledge about the apartments, because why? 𝐓𝐽𝐺 PLC provide property development, architectural and construction services. That is there at the very beginning of the question. So which means with regard to the apartment development and renting it out, right, 𝐓𝐽𝐺 has the experience. Okay, so here you have the experience for this activity to use as an apartment. But here, resort, they don't have the experience. Okay, how that would be captured into your answer? Right, so these are information in the question. So sometimes examiner purposefully put you in trouble, right, giving some information, right? Okay, right. So now what we need to do is we need to look at advise the management of Gamma how determining the value of the land based on the applicable accounting standard and what is the value gain to be recorded in the financial statement for the year ended 31st March 2025. Now, what is the standard that talks about the concept of fair value? SL-25 13 fair value measurement standard. What that standard does that standard mention what are the items to be measured at fair value? No. What are the items to be measured at fair value and when to measure the fair value is discussed in those separate standards. Right? When a separate, let's say it can be LKS 16, property, plant and equipment. It can be LKS 40, investment property standard. Right? So, when a separate standard, when a specific standard requires an item to be measured at fair value, what SL-25 13 does is SL-25 13 provide guidance on how to fair value, how to calculate the fair value. What to fair value, when to fair value, those are in the separate standards. Now, first of all, then you need to understand for this particular land, account for this particular land is covered by what standard? What do you say? Land. So, when it comes to a land, if it is own occupied, it is a what? Property, plant and equipment under LKS 60. If it is own occupied land, you use your own land for your purpose. Then, if you use a land for rental purpose, you rent it and earn a rental income, or you keep the land for capital appreciation purpose, then it is a what? Investment property covered under LKS 40. Now, with regard to this land, what it's mentioned is there's a land 320 purchases. Purpose is not yet what? Determined. You have not yet decided for what purpose this land is going to be used. Then what the standard LKS 40 says is, if there is a land which has undetermined future use, it is a what? Investment property. LKS 40. The reason is why? If you don't have any purpose for which this particular land is going to be used, logically only purpose is what kind of a capital appreciation that would be there on this land. So because of that, LKS 40 specifically mentioned that if there's a land which is where the use is not yet determined, purpose for which this land is going to be used is not yet determined, it is a what? Investment property. So that you need to apply LKS 40. Right? Right. Then investment property standard says that subsequent measurement of the investment properties, you can use two methods, either cost method or the fair value method. Cost method, all of us know. Cost minus accumulated depreciation minus impairment losses. Right? As this is a land, no depreciation, that means cost. Model means the cost. Then what is the other option? Either to use the cost model or the fair value model. Fair value model means what? You fair value the particular land at the end of each year, and the fair value gains and the losses are taken to the profit and loss statement. Right? So, in the fair value model, there is nothing called depreciation. Anyway, this is a land, no depreciation. But if you use fair value model under LKS 40, no depreciation, fair value gains and the losses you are taking to the profit and loss statement. So, seems that in this situation, company is using fair value model as the subsequent measurement model of the investment property under LKS 40. Are we clear? Are we clear? Right. Now, LKS 40, that is the specific standard, requires this investment property to be measured at what value? Fair value. Then SL-25 13 would come into play. SL-25 13 then provides guidance on what? How to fair value. Right? What to fair value, when to fair value is discussed in where? LKS 40. SL-25 13 fair value measurement standard guides you on how to measure the fair value. Right? Now this is how this applicability of SL-25 13 would come into play. Then what they have done is, last year they used a recent market transaction of a similar land in the same location to measure the fair value. 1.3 million per perch into 320 purchases, 416 million. Current year, you are going to use a valuation report. You are taking the support of a valuer because there are no recent transactions of the lands in the same location. So that you are taking the support of a valuer and you are using a cash flow based method to estimate the fair value. So that's why you have been given the discounting factors and the growth rates as the assumptions. Right. Now, hope you can remember, right? So in terms of SL-FRS 13, if you revise the theory knowledge, you have different valuation approaches or valuation techniques. You have market approach, income approach, cost approach. Then you have something called value hierarchy based on the type of input that you use, whether it is level 1 inputs, level 2 inputs, or level 3 inputs. So I'll come there, right? I'll show you the relevant theory tutor as well. Now, in addition to that, this particular question is tested from which area of SL-FRS 13? Fair value measurement of a non-financial asset. This is not a financial asset, non-financial asset, land. When it comes to the fair value measurement of a non-financial asset, how do you measure the fair value of the non-financial asset? What it says? Because here you have two purposes for which that land can be used. Then which one are you going to take? Are you going to assume like this, because company doesn't have any experience in resort operation, so that we have to use the fair value as per using as an apartment? So are you going to take that approach? No. Remember, the standard SL-FRS 13 clearly mentioned that fair value is not an entity specific concept. It is a what? You have to fair value, when you want to fair value an item, you have to look at from the market participant's point of view, not entity specific. Entity doesn't have the experience to operate as a resort is not applicable for the fair value measurement. If you are a market participant, how are you going to look at this scenario? Right? Based on that, you value this particular land. Then when it comes to non-financial assets, it says that the fair value has to be the highest and best use. What do you mean by highest and best use? Whatever the option or whatever the suggestion or whatever the alternative which gives you the highest value, best value. So that has to be used as your fair value estimate, because why? If you are a market participant, you always go for the best use, highest return. Now, accordingly, in this situation, what is the highest and the best use? If you are a market participant, you would go with the second option, right? Because it will give you higher fair value, which is what? 1.6 million per patch. Okay. Then, what is the value? If it is 1.6 million, what you do? You multiply this by 320 purchases. How much? 512 million. It is 512 million. So the value has gone up. 416 million to 512 million. So then what is the value gain? Very simple. So the question wants us to calculate the value gain. How to calculate the value gain? 512 million minus last year figure. 416 million. How much? 96 million. This is the value gain. What do? This value gain you need to recognize in the P&L. You debit the investment property value goes up, credit to the P&L. Okay, that's what you do. Then what else that you can talk about this particular matter? What you need to highlight in the examination? So you see, Compared to the last year, there's a change in valuation technique and the value hierarchy. Right? First of all, what are the valuation techniques that you have learned? So have we learned? Yes, we have. I'll show you. So I always do that because I told you there's nothing outside what we have learned in the class, right? So I'm not going to go through everything. I'll highlight you the important aspects. The point what I mentioned, fair value is a market-based measurement, not an entity-specific. You have to look at from the market participants' point of view. Okay, this is what I mentioned. So how many valuation approaches are there? So to fair value an item, there are 3 approaches that you can use. Market approach. What do you mean by market approach? Calculate the fair value based on the recent sales prices. Last year, that is what we have done. We calculated the fair value of the land based on the recent market transaction of a land in the similar area, same area. So that what is that approach? Market approach. Last year we have used the market approach. Then income approach. Valuation is based on the forecasted cash flows. This year, what I'm going to use? Based on the valuer's report, valuer has used what? Income approach. He has forecasted the future cash flows and based on that he has valued the land. So then there are 2 purposes, apartment and resort. Now we decided highest and best use is the resort. What approach? Income approach. So basically, you have to disclose that. You have to prepare the disclosures. So you have to disclose saying that your approach or the technique of fair valuing the land has been changed during the year from market approach to income approach. You have to explain why you have done that. Right? And also remember, this is actually a what? Accounting estimate change. Accounting estimate changes are adjusted anyway prospectively. Prospectively means now this year you are using the income approach, right? You don't want to go back and adjust your past numbers. If you adjust the past numbers, that is a retrospective adjustment. Accounting estimate changes are adjusted what? Prospectively. So that whatever the numbers that you have done in the last year, you don't need to change. Right? Then the third approach is actually what? Cost approach. That is based on the replacement cost. For example, let's say to replace similar type of land, how much of cost that I need to incur. Right? That is the third approach that is not in use in this particular example. So we have 3 valuation techniques. Then one more thing. I'm not going to explain everything as I mentioned because of the limited time available. Hierarchy, value hierarchy. Level 1, level 2 and level 3 inputs. So hierarchy means what? You have to first of all look at when you are fair valuing an item whether the level 1 inputs are available. Level 1 inputs mean highest quality of inputs. Quoted prices for identical asset in an active market. 3 things. Quoted prices, identical asset in an active market. For example, let's say if you have equity shares of a listed company, what you can do is you can look at the price of the Colombo Stock Exchange, share price of the Colombo Stock Exchange, and you can value that. So that is what level 1 input. Level 2 inputs mean what? In summary, the observable input, but these are not level 1. So actually last year, you have valued your land based on the what? Recent transactions, which has happened. So that is a kind of what? Observable input, not entity specific input. It is available to all market participants, not only to your entity. So last year actually I have used what? Level 2 inputs. This year, what you used? Level 3 inputs. Because why? These are unobservable inputs. So your cash flow estimates are available only to you. The valuer has done a cash flow estimate. Based on that, he said that, okay, this is the value of the land. So these estimates, assumptions that you have made are only limited to whom? You, entity specific. So relevant to that particular entity. So those are what? Unobservable. The important word is unobservable inputs. This could include here, it's mentioned, cash or profit forecast used by the entity. Used by the entity by using entity's own data. So see, so everything what is tested in the exam, in this pilot paper is there in the tubes. So if you have gone through the tubes, right, this would be very simple. right? So now what has happened? Now value hierarchy also there's a change. Last year you have used level 2 inputs. This year you have used level 3 inputs. Now the disclosure. You can prepare actually many disclosures. Even though the examiner was asking about 4 disclosures. Right, okay. That's enough, right? So I discuss actually more than what is there in the suggested solution. You can go through, right? You can go through, but I have covered everything, right? I have covered everything. Thereafter, now we answer to part, we have answered to part B, right? How determining the value based on the applicable accounting standard and what is the value gain and how to account for that. We have done it. 5 marks, easy marks, right? Then you are asked to prepare 4 disclosures. I have mentioned number of disclosures, right, that you can make. In addition to that, suggested solutions also given certain disclosures. So let's see what the disclosures are. Now you have to disclose the information what we have prepared. First of all, you have to mention that this particular land is a what? Investment property, right? Which has a fair value of 512 million at the year end. 320 purchases, right? 320 purchases into 1.6 million. That would give you 1.6 million, right? Yeah. 320 purchases, 1.6 million. So the fair value is how much? 512 million. So we have to disclose the fair value. Then what is the hierarchy that we already discussed? Level 3. What is the technique or approach? Income approach. That also we discussed. Then key assumptions that you have used. That is given over here. Discount rate, how much? 8%. Growth rate of the cash flows or the growth rate of revenue, right? 12%. Discount rate, that is to discount the cash flows. The value has used 8%. So those to be disclosed. Right? In addition to that, you can disclose because you have used a qualified valuer for this purpose. You can mention that who the valuer is. You can mention that this has been valued by using the report given by chartered valuer so and so. That is also a disclosure. That has to be disclosed when you have a fair value computed of a land and that you are taking from a valuation report. You have to give the details about the valuer. So his qualification are this, and this is the person or this is the firm, company who has done the valuation. Another disclosure. We can make any number of disclosures. So then in addition to that, movement or the change in the fair value. I explained this. Last year, what was the fair value? 416 million. That is 31st March 2024. Fair value is 416 million. Current year, fair value is how much? 512 million. Fair value gain, 96 million. So that you disclose. Opening balance, fair value gain, closing balance, 512 million. 416 million is the opening balance. Fair value gain of 96 million. Closing balance is 512 million. Simple. And this value gain is recognized where? In the P&L, 96 million. 96 million is recognized in the P&L because value model of LKS 40 says that value gains and the losses are to be taken to the profit and loss statement. Then another disclosure that you can do is actually about the sensitivity analysis. So the sensitivity analysis is done based on the main assumptions. Now, one of the key two assumptions, what is mentioned in the question is discount rate of 8% and growth rate of 12%. You can mention that. If discount rate changes by 1%, 1% increase or 1% decrease, both ways you can explain. If discount rate increases, what will happen to the fair value? Will it go up or come down? It will come down because why? You are discounting at a higher rate means fair value is coming down. On the other hand, if discount rate reduces, fair value will go up. You can mention 1% change in discounting factor will increase the fair value by this much. 1% reduction in the discounting factor will increase the fair value by this much. You can explain. That is the sensitivity analysis. It's a disclosure. Similarly, growth rate. Once the growth rate is higher, fair value is higher. Once the growth rate is lower, fair value is lower. You can mention If 1% increase in the growth rate would increase the fair value by this much. 1% decrease in the growth rate would decrease the fair value by this much. So that is the sensitivity analysis disclosure. Okay. Right. So that is the answer. I have actually explained more than what is there in the suggested solutions. Right. You can again go through. So what I wanted to mention is these are bonus marks. Don't miss these marks in the examination. You're very lucky if you get questions like this nature in the real examination. Okay. Right. Again, the point what I wanted to highlight is don't miss any theory tudes, right? So you have seen that. So we are discussing the question number 3 of the pilot paper. There are no questions, absolutely no questions other than what is there in the tutorials, right? If you know the theory, you can answer to the question, right? Good that if you have the practice of doing the past papers, model papers, but the most important thing is be thorough with the theory, right? So these tudes are prepared, PowerPoint presentations are prepared by giving a lot of effort into the areas which are important, which are relevant, and which are examinable in the examination. So that focus on those areas. Don't miss out. Don't try to prepare short notes out of the tudes. Tudes are the short note. There's nothing other than that. You can't prepare your own notes summarizing the tudes. Every word, every slide, every area of these tudes are important for you to successfully face the examination, right? Okay, so that's it. So we have answered to actually part B and C of the paper, of the pilot paper targeting June 2026 examination. So we have answered. So these two questions are from SL-FRS 13, as I mentioned, and also you need to have the knowledge of LKS 40 as well, investment property standard as well. Let's discuss part D of the question number 3 of the pilot paper. This is the last part of this question. What is required there? Advise the management of gamma on the determination of these transactions as related party transactions in accordance with the applicable accounting standard. So what is the accounting standard relevant with the related party transactions? LKS 24, related party transactions. So where are related party disclosures? You need to identify. Now there are number of transactions given in this situation, right? There are number of transactions given in this situation. You need to understand and give you a comment on whether these transactions are related party transactions that are to be disclosed in the financial statements. Okay, right. During the financial reporting period ended 31st March 2025, Gamma entered into transactions with the following parties. Okay, so the standard LKS 24 has two main parts. The first one is identification of related party. You have to identify whether a particular party is a related party or not. Second thing is make the disclosures relevant to that particular related party transaction. So once you identify, if you carry out any transactions with the related parties, you need to disclose about the transactions in the financial statements, right? So there are 4 transactions. So the number one is, the first transaction is with 𝐒𝐿𝐵𝐚𝐴. So nature of services is, so that person provided architectural services to the company. What is the value? So seems that company has paid him for his professional service 675,000. So the important aspect is, who is Rasika? Rasika is the son of Malaka 𝐒𝐿𝐵𝐚𝐴, an independent director of Gamma. Okay, who is Rasika? Rasika is the son of Malaka 𝐒𝐵𝐚𝐴. Son of Malaka 𝐒𝐵𝐚𝐴, who is an independent director. Okay. So when it comes to the standard, you identify certain entities as related parties as well as certain individuals as the related parties. So key management personnel of the company are related parties. So what is key management personnel? A person who has the authority of planning, directing and controlling the activities of the organization is considered to be a key management personnel. So your board of directors, whether they are executive, non-executive, independent, non-independent, your board of directors are obviously key management person. And in addition to the board of directors, there can be other executives like CEO, CFO, right? So those parties are identified as what? Key management personnel of the company. Then this guy who Rasika is son of the director, independent director of the company. So what is that? Close family members. Then standard also identifies close family members of the key management personnel are related parties to the entity. Now the question is whether the son of the independent director, whether the son of the director, son of the key management personnel is a close family member or not. What do you say? Yes, son is a close family member. So the standard specifically identifies children are what? Close family members. So in the standard, under the definition of close family members, there are certain people. So the standard gives you the examples by using the word include. Include means there can be many other people, but one of the example is what? Children. So children are close family members of the key management personnel, so that this particular transaction where the company has paid 675,000 to 𝐓𝐫𝐚𝐧𝐬𝐼, who provide the architectural services, is a related party transaction that has to be disclosed in the financial statements. I hope you are clear, right? So yet again, I'll show you as always, what are we discussing? So what are we discussing? I told you there are entities and there are individuals who identify as the related parties. When it comes to the individual, key management personnel are related parties. Their close family members are related parties, right? So with regard to key management personnel, over here I have specifically mentioned that board of directors are key management personnel. Where is that? Yeah. Here, if you look at the definition, key management personnel are those persons having, if I put this into full screen, okay. Key management personnel are those persons having authority and responsibility for what? Planning, directing and controlling the activities of the entity, directly or indirectly, including any director, whether executive or otherwise. It can be executive, non-executive, independent, non-independent. Always directors are key management personnel. In addition to that, there are some other individuals who are not directors, can be the key management personnel like CEO, CFO, because they are getting involved in the planning, directing and controlling the activities of the entity. Right. So then the definition of close family members. Close family member is defined in this way: a person, close members of the family of a person are those family members who may be expected to influence or be influenced that person in their dealing with the entity. So any family member who can influence the key management personnel or else be influenced by the key management personnel, both ways. There can be a family member who can influence the key management personnel. In addition to that, key management personnel can influence that particular family member. Then they are become what? Close family members. Then I mentioned that the standard identifies some parties, and standard use the word include. Include means what? This is not the full list. These are few examples. So in this example, the first point is what? Persons, children, spouse or the domestic partner are what? Close family member. Now in this situation, son of a director, son would become what? Close family member of key management personnel, so that son is a related party to the entity. If it is a related party, you need to disclose. Right? Clear? Okay. Again, I don't have time to go through everything. Right? So it's your duty. If you can't remember, go and watch the video and look at the tutorial, understand this, right? It's very important. Right. First one is clear. Now look at the second one. Lalith Abesinghe, who provide the construction services. So the value is 5.5 million. Jagat is the brother, this time not the son, brother of Malaka Abesinghe. Again Malaka Abesinghe, same person. And a reputed practicing lawyer, right? Now, so we know who is Malaka Abesinghe, is a director. Then in this situation, who has provided the service? Brother of Malaka Abesinghe. So that brother is a reputed lawyer, practicing lawyer. So the name of the person is Janith. Now the question is whether the Janith is a related party and this particular transaction has to be disclosed. So now it is obvious Malaka is a key management personnel director. Then the question is whether Jagat, brother of the key management personnel, is a related party or not. So again, if I go back to the tutorial, what it says here, we have been given examples for the close family members, and the standard, as I mentioned, repeatedly mentioned, use the word include. That means there can be many more. So the children, spouse, or the domestic partner. Thereafter, not your children, but it can be your spouse or the domestic partner's children. That means legal things are not valid in terms of the accounting. Even though you are not, it is not your children, if it is your spouse's children or your domestic partner's children, would become what? Close family members. Okay. Then dependents of that person, dependents of the KMP or that person's spouse or the domestic partner. It can be your dependent, or it can be your spouse's dependent, or it can be a dependent of your domestic partner. So they are also close family members. So it is broad, wide. So then it says that other family members. Now children has been specifically identified. Spouse has been specifically identified. But parents, brothers, sisters are not directly identified. It is not given as the examples. But it doesn't mean that they are not related parties. You have to look at carefully. Right? So what it says, other family members such as parents, brothers, sisters could also be included. Very important, this is what you remember, particularly where they have been influenced by or had influence over the individual in their dealing with the entity. Now, in summary, applicable to this particular question is now what? There's a director, director's brother is a lawyer, that lawyer has provided certain services to the entity. Whether that brother of the director, brother of the key management personnel is a related party or not. To make him a related party, either that particular brother has to be a dependent of the key management personnel. Now, if he's a practicing lawyer, you can't say that, you can't conclude that he's dependent on the director, right? So that's why it's mentioned that he's a practicing lawyer. He has other revenue streams, right? So because of that, it's difficult to conclude that brother is depending on that particular director. Seems that he's not a dependent. Then what you look at is whether that brother can influence the director, or else whether the director can influence the brother in the dealing of the business. Right? It is not directly mentioned whether the brother can influence or whether the director can influence the brother. So because of that, we don't have evidence to conclude that brother of the director is a close family member and the transactions are to be disclosed in the financial statements. Right? So then it seems that this is not a related party transaction. So the lawyer has provided services to the entity in his usual course of business. Let's read the suggested solution as well. So the first one is clear, no? First one is son, very direct. Rasika Amrasinghe, son of Malaka, should be considered as a related party as children of key management personnel meet the definition of close family members as per case 24. That's clear. Now the brother. Janith has to be considered as a close family member of Malaka only if he is dependent on Malaka or expected to be influenced by Malaka or to influence Malaka per the close family member definition provided in LKS 24. As he is a practicing lawyer, it's highly unlikely that he is dependent on Malaka. However, based on the facts and circumstances, it's required to assess the ability of influence or to be influenced. That is not clear. That's why I mentioned that. So my judgment and what is then the suggested solution is correct. We don't have information here, but it seems that as information is not available, so this is not to be a related party transaction, but there's information gap in this particular scenario. Right, okay. So let's look at the other two as well. I hope you are clear, right? So there are 4 transactions given. Right, there are 4 transactions given. Out of that, 2 we discussed. Then I told you there can be related parties, people or individuals, as well as entities. So the last 2 are relevant with the entities. What it says? Moon Private Limited. So the Moon Private Limited provides construction services to Gamma, our entity. So the value of the service is 5.3 million. Now what happens here? Malaka is everywhere, right? Malaka 𝐓𝐫𝐚𝐽𝐬𝐻, you know who is Malaka 𝐓𝐫𝐚𝐽𝐬𝐻? He is a director of Gamma, our company. Is also an independent non-executive director of Moon. Okay, here. Now Malaka is a director of our entity, Gamma. So there are 2 entities. You have Gamma, you have Moon. 2 separate entities. Moon Private Limited, Gamma means our entity. So Malaka, there's a person called Malaka. He is a director of Gamma and director of Moon. Right? He's a director in both entities. Now the question is, once you have a common director, now Gamma and Moon they have a common director called Malaka. Whether these 2 entities are related parties, what do you say? No, right? Because if that is the case, a lot of entities are related. Because you have directors who are holding the directorship of many companies. Just having a common director doesn't mean that 2 entities are related. So in this case, then what? Moon Private Limited is not a related party for Gamma, so that you are not required to make any disclosures in terms of this. Right? Are you clear? Right. Simply having common directorship will not create related party relationships as per paragraph 11 of LKS 24. Accordingly, Moon Private Limited cannot be considered as a related party due to the existence of common directorship. Very simple. No? Right, finally, Moon is over, now Star. Right, let's see what has happened there. Star. Right. Star Private Limited yet again provide the construction services. What is the value? 5.2 million. Now what has happened? Controlling shareholder of Gamma, okay, controlling shareholder of Gamma, Ranjit Sumanananda is a non-executive director of Star. Okay, now here it is a little different. Again, you have 2 entities. What are 2 entities? What are 2 entities? You have Gamma, this is our entity. Gamma, and there's another entity called Star. And who is the person here? Ranjit. So you have Ranjit. And Ranjit is the controlling shareholder. That means Ranjit holds seems to be more than 50% of ownership of gamma. So that's why he can control. Okay, or any other means he somehow control gamma. Okay, so if Ranjit is an entity, that is a parent entity, something similar to that. Your parent can be an entity, or you can have a controlling shareholder. In this case, you have a controlling shareholder who holds what? Assume you have more than 50% of the voting rights of gamma. So we are discussing the matter from the perspective of gamma, right? This is our entity, gamma. So the Ranjit is the what? Controlling shareholder here. Controlling shareholder of gamma. And he is a director. Director of Star Limited. Now the question is whether gamma and Star are related parties. Right? When you are controlling shareholder, like similar to your parent company. Okay, when your controlling shareholder holds a directorship of another entity, that particular entity would become a related party. In this case, what has happened is that your controlling shareholder holds the directorship of Star. So Star is what? A related party to gamma. Because why? He controls this. And he is in the board of Star. So he can influence the transactions between gamma and Star up to an extent. So because of that, so again I'm repeating, you are controlling shareholder of the entity, that is controlling shareholder of gamma, Ranjit. He is a director of another entity. That particular entity, that is Star, and your entity gamma are related parties. Right? So that you need to disclose this particular transaction under LKS 24. Let's see the answer, what is given in suggested solution. Yeah, correct. Star needs to be considered as a related party as one of the directors of Star is the controlling shareholder of gamma, your entity. Star qualifies to be recognized as a related party as per the definition in LKS 24. Right. Okay. So with that, actually, we completed answering all the parts in question 3 of your pilot paper issued in January 2026, but by targeting June 2026 examination.